Well, happy Wednesday. It's an interesting day, There's a lot of things going on. There's a lot of things I could talk about, but I have just one question. One question. And also, I got to change something. It's not us banks, it's U.S. banks. But are U.S. banks safe as Fed increases rates again? Because we were told that the reason why the last couple of banks failed was because the Fed was hack, raising the rates, and they weren't able to keep up with the rates, and they collapsed under them. And there were some other things going on. There was also a bank run at the same time. And it seems like to be a bank run on a lot of banks right now. But Fed hikes increased rates by 2.5, so a quarter of a percentage point, but signals a pause in inflation fight. I mean, we could solve inflation if Congress would just kind of stop spending. And what I mean by spending is that we start paying down our debt and to stop any new bills, any new spending, I should say. The Fed's most aggressive right campaign in 40 years may be history. The Federal Reserve raised its key short term interest rate by a quarter of a percentage point Wednesday and signaled that it could now pause if inflation continues to ease as expected. In a statement after a 2-day meeting, central bank removed previous guidance that some additional policies firming rate hikes may be appropriate to lower yearly inflation rates to its 2% target. I mean, why do we have 2% inflation? Why can it not be like 0% inflation? Instead, it says its policy making committee will closely monitor incoming information and assess the implications for monetary policy and to determine to extent in which additional policy firming may be appropriate to returning to inflation to 2% over time. The committee will also take into account rate hikes so far, the lags with which they affect the economy and inflation, and the economy and the financial developments. Those are just additional. The central bank stopped short of stating that the rates are probably high enough to lower annual inflation to 2% target. As some economists anticipated, that will likely have been more emphatic preference for a pause. Still, inflation and the labor market show signs of cooling down significantly by the Fed's mid-June meeting. As many economists expect, Fed officials appear to be inclined to halt the rate increases. Otherwise, they could bump up the rates again, despite the growing risk that the moves triggers a mild recession later this year. I think we're already in a recession, although they keep on redefining it. Our future policies action will depend on how events unfold. The Fed Chair Jerome Powell said at a news conference we are prepared to do more if greater monetary policy restraints is warranted. Powell added that the Fed didn't formally decide to pause the rates, but he pointed that the deletion from the statement that the guidance from further rates increase may be appropriate. That meaningful change, we're no longer saying that we anticipated more hikes. The Fed repeated that we'll consider the effects of Silicon Valley Bank crisis, which prompted the banks to tighten up lending standards that will likely to weigh on economic activity, hiring, and inflation. The extent that these effects remain uncertain. In other words, it's tougher for consumers and businesses to borrow. That could lessen the need for more rate increases. The principle we won't have to raise rates quite as high as we would have if the banking crisis hadn't happened. Well, cause and effects. So the central bank reached the peak interest. We may not be far off, but possibly even at the level, he said, adding that it will depend on how the economic activity and inflation evolve. Although most economists and the Fed staff believe that the rate increase will tip the economy into a mild recession this year, Powell said hiring is still so strong, it's possible to cool the labor market enough to bring down inflation without triggering a downturn. I'm still a little confused why hiring is causing inflation. I thought people having more money would cause a deflation. The case for avoiding a recession, in my view, more likely having a recession, he said. The case for avoiding a recession, in my view, more likely having a recession, he said. Makes no sense. The Fed hikes is the key to a range of 5% or 5.25%, the highest in 17 years, and the Fed got there in near record time, hosting a rate near zero in March 2022. So it sought to beat back inflation so it could reach a 4-decade high as last June as the economy continues to emerge from the pandemic. Although consumer prices increase have softened since then, the core measuring that strips out volatile food and energy items has climbed more than expected this year. Oh wow, food and energy that relies on gas, which funny enough that Joe Biden is waging war on, got rid of the Keystone XL pipeline, which triggered the inflation. Funny how they want to ignore that part. Has climbed more than expected this year, prompted futures markets to predict that the Fed would lift rates as high as 5.6 in 2023. But March failures of Silicon Valley Bank and Signature Bank have caused financial institutions to toughen lending standards, and that the Fed's officials have said that they're likely to slow the economy and inflation, leaving less work for them to do. This week, First Republic Bank collapsed as well. Fed policymakers will also be hesitant to intensify strains of the financial systems, consider a rate hike themselves fueled by the crisis by causing big losses at some of the regional banks heavily invested in rate-sensitive bonds, economists said. As a result, the Fed in late March estimated it will raise its key rate to peak of 5% to 5.25%, then pause. The latest hike is expected to further slow economic activities as it drives up rates for credit cards, adjustable rates mortgages, and other loans. But Americans, especially seniors, are finally reaping higher banking saving yields year after year of mergers return. Is the job market slowing down? I don't know, is it? I'm only going to read a couple more of this and I'm going to go to another story. The Fed is trying to walk a fine line as it digests conflicting economic signals. Although March 236,000 U.S. jobs gained with sturdy monthly payroll increases have slowed significantly from early this year, and an April employment report due out Friday is projected to reveal another downshift of 180,000 new jobs, according to economists' estimates. Job opening declines to 9.6 million in March, an historically elevated total, but the lowest in many 2 years, the Labor Department said Tuesday. And since the labor force, which includes people working and job hunting, has swelled nearly 2 million people so far this year, the number of vacancies per unemployment worker dropped to 1.6. That's still high, but it's the lowest level since 2021 and marks a step towards better balance between job openings and workers. The goal the Fed is seeking is to slow pay increases that may be compounding inflation. So I guess if you get paid a crap ton of money, you're adding to inflation because you have more money to spend, which means you could afford higher expensive items. But if your basic necessity is going higher, then I guess that means you're adding to inflation. Let's see how the U.S. economy is right now. On the barometer of economic activity is also moderating, largely due to the rate of increase in national gross domestic product, grew at a modest 1.1% annual rate. In the first quarter, consumer spending, which makes up 70% of the GDP, increased more robust by 3.7%, and outlays have lost steam since the weather-related surge in January. Manufacturing output has also declined. A pullback in consumer demand and hiring theoretically could curb inflation, but price increases have drifted down gradually unless you're dealing with gasoline and food. Let's see here. All right, this one's a short one. The road to the First Republic Bank collapse. This is May 1st. JP Morgan is buying the most of First Republic Bank in the last-ditch rescue to strain lenders, marking the third major U.S. bank to fail in 2 months. Last week, First Republic reported more than $100 billion plunge in deposits in the first quarter that sparked a brutal sell-off of the lender's share. Banks have been staring at the biggest crisis since 2008, and 2 U.S. lenders collapsed in March. The turmoil has reached up fears of contagion and prompted action from the U.S. Federal Reserve, U.S. Treasury, and the private sector. So let's hear crypto-friendly bank Silvergate Capital says it would wind down operation. So this isn't really cutting out. But anyways, are banks safe? Because it seems like they're not. I mean, if you're a major bank, it looks like you're not safe. And I don't know what that really means. I don't know what that's going to refer to. Let's see here. That was back in April. See what the New York Times have to say. Bank rival appears firmly footing this time, in contrast and widespread panic failures of Silicon Valley and Signature Bank. Is the worst of the banking crisis over? It may seem strange to question, but posed shortly after the collapse of the First Republic Bank, the second largest failure in U.S. history, but many industry experts said that the problems were unique to the once high-flying lender. Investors also appear to reach the view the First Republic hurtled towards collapse, which is stock dropping precipitously. Financially, markets were far calmer in mid-March than when the failures of Silicon Valley Bank and Signature Bank provoked a panic that engulfed the industry. First Republic was seized by regulators early Monday morning and also sold to JP Morgan. The S&P 500 stock index barely budged in trading, and JP Morgan shares gained about 2%. The decline in many smaller bank shares, which were shaken by turmoil in March, which were relatively muted, echoing failures of Silicon Valley Bank and Signature Bank. First Republic collapsed after depositors and investors abandoned the institution, pulling their money and selling their shares in droves. As well as also include real estate loans that lost value rapidly as interest rates rose, and the concentrated customer base of wealthy depositors who withdrew large amounts of money quickly, so it was a bank run. Many banks still face tough economic conditions, but no other prominent lender appears to have a similar set of urgent challenges that underlined over the past few weeks, as dozens of regional banks reported their first quarter offering a less grim assessment of their prospect. Many investors, analysts have feared. The problem is that the First Republic were visibly already on March 10th. Nicholas Vernon, a senior fellow at Peterson Institution for International Economics, said, referring to the day Silicon Valley Bank collapsed, "To me, this is just leftover from previous episode. The only surprise here is taking so long." Republic lost $102 billion in deposits in the first quarter, but with withdrawals at other banks stabilized much more quickly. PacWest Bancorp, Los Angeles lender, lost nearly $6 billion in deposits during the quarter, But in late March, the outflow had reversed, according to the executives. Western Alliance and the Arizona Bank that has drawn scrutiny added $2 billion in deposits in the first half of April. The KBW Regional Bank Index, an index of smaller regional lenders in the United States, lost little ground as the First Republic stock was in free fall, a signal that investors view First Republic as an isolated problem rather than a harbinger of more trouble to come. That's a message that many bank executives have tried to send as they distance themselves from sickened rivals. As much a different response than investors had in March after a sudden collapse in Silicon Valley Bank Index plunge dragged the border stock market lowered amid the fears. Yada, 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 yada. This really isn't saying much. Let's see here. Federal Reserve has lending programs in place for struggling banks, including one created last month that offers banks loans against certain distressed assets of their original value. Dr. Pirozovsky considered that's a good short-term intervention, but remains concerned about the consequences later this year if economic conditions worsen. So that's a temporary band-aid. The signs are not necessarily encouraging, he said, citing article perils like slowing job growth and nearly frozen housing market. These are not favorable conditions for the banking systems, adding that pressure smaller banks will face. In the coming months and years, analysts expect stricter regulation, supervision, and eventually new rules. Three government reviews released on Friday spotlighted regulatory sluggish and failures that allowed Silicon Valley Bank and Signature Bank to grow despite clear signs of trouble. They just flat out ignored it and then it happened. That would probably lead to banking regulators more quickly flagging and more quickly correct the problems that could cause turbulence for banks. Opposition from the banking industry is probably not going to make much of a difference this time, says Ian Katz, a managing director of Capital Alpha Partner, a Washington research firm. The win is at the back of the regulators to do something, but now any immediate contagion from First Republic appears contained right from the beginning when Silicon Valley started to collapse. The screens were run and the weak players were identified, said Stephen Bigger, an analyst who covered JP Morgan at Argus Research. The conclusion that the First Republic at this point should have alleviated a lot of its concerns about the banking crisis. All these banks are in stronger hands now. Let's hope so. With that being said, that is my video for today. This is kind of out of my wheelhouse because I know a little bit about fundamentals of banking. I understand some economics, but don't know what the outcomes of this is going to be. I don't know if we're going to see something like 2008 or we're going to see something, I don't know, like 1929. Hopefully it's not 1929, and hopefully it's not 2003. Hopefully it's just a blip that we could easily correct, but I don't know if our banks are safe. I mean, they're not going to be safe if you do a bunch of bank runs. That I do know for sure. But hopefully there's no more bank runs and our financial institutions are safe. But I don't have much faith in this president, in Joe Biden, to incorporate that, because he kind of kicked us off when he gave us inflation, when he went to war with the oil industry, which a lot of our transportation is done through gasoline or petrol. And when you raise the price of petrol, you're going to see inflation, which you're going to see higher grocery bills or higher energy bills. I don't know. I don't know what to say, but other than that, it's my video for today. Hopefully you all have a awesome day. That being said, have yourself a wonderful day, morning, or evening.